Alright guys, welcome back. In this video, I want to talk about, are stocks cheap? Okay, spoiler alert, they are, but they also may not be at the same time. So what do I mean by that? Firstly, on a relative basis, they absolutely are. Just objectively, stocks overall, I guess other than energy, but stocks overall are down from where they were a month ago, 3 months ago, half a year ago, especially technology stocks, especially the high risk stocks, or even crypto for that matter. Absolutely, they are cheaper than they were before. So are they cheap relative basis? Absolutely. But on an absolute basis, they may or may not be, because we don't know what happens tomorrow. We don't know what happens in 3 or 6 months from now. We only know after it happens. So if we were at the bottom and we started rebounding from here, then yeah, they are cheap absolutely, and we are at the bottom. But if we continue falling for the next 3 or 6 months, then they're just going to get even cheaper from where they are right now. Now, there are some metrics that you can look at, for example, price to earnings, which we're going to look at in a second, which can tell you whether they are cheap historically or not. But again, that doesn't necessarily mean that we are at the bottom or even close to it, or perhaps it means we're exactly at it right now. We don't know until after it happens. So for example, let's take a look at Yardeni research. You can easily just go to Google, write Yardeni research PE ratios. It's the first PDF that shows up. So we look at forward PE ratios for the S&P indexes. So we have the large caps, we have the mid caps, and we have the small caps. So firstly, large caps. Right now we have finally come to where we have been historically on average for the past 20 or so years. Below a PE ratio of 16 at 15.9. Again, if you look in recent history, the bull market over the past 12 years or since the Great Recession, a great time to have gotten into the markets if you were fortunate enough in looking at these numbers and you had the means to do so 12 years ago. And yeah, it was volatile, but again, after that big run up from the end of 2011 all the way up to about, let's say, 2015, and then we traded in a range from between, let's say, 14 to about 16, 17 in that average, and then all of a sudden COVID happened, we dropped all the way down to maybe 13, 14, and then shot right up. Again, a lot of money in the system. The Fed was printing money like no tomorrow, and for the better part of 2020 and 2021, we were between, let's say, 20 on a PE ratio and, let's say, 22, 23. And now the bear market that we've been in, we have fallen from, let's say, 21, 22 to where we are right now at 15.9. Again, to where we have been over that past decade. Again, not to say that we're absolutely not going to fall any lower from here. We very well could. We've seen in the past that we have fallen very, very low. Who's to say that we're not going to go back to 12 or 14 or 10 or 8? Who's to say that, right? But again, back in that average, maybe this is where we find some kind of buying pressure, perhaps not. When we look at the S&P 400 mid-cap at 11.6, or where we are right now, trading very similar to where we were during the shock in March of 2020, lower than where we were in the lows of 2011, but not nearly as low as we were during the great financial crisis, where again we hit a PE ratio of about 8 to where we are right now at about 11, but again, way below average. Again, we saw that during that bull market run. That average was between, let's say, about 15 and let's say about 18 on a PE ratio. And small caps, this one is where we are historically low. And again, we have been low on the small caps ever since the end of 2021, and it's continued getting lower and lower and lower. At the end of 2021, we were at about, let's say, 15, 16, which was again below that average, let's say, over the past 10 years. And right now, we're pretty much as low as we were during that COVID shock, as well as during the great financial crisis. We're pretty much nearly there. So again, relatively, we're almost as cheap as we've ever been. Absolutely, maybe we're going to make a new historic low for all we know. And I also want to quickly take a look at some technical analysis, specifically on the weekly charts of all three of these different indices. The first one being the S&P 500 or the SPY. On the weekly, the 200 simple moving day average. So during that COVID crash, we crashed below that weekly average. If we go back to the great financial crisis in 2008, again, we were way below it during a recession. But again, during recessions, the 200 simple moving day average doesn't hold up. But if we look today, we're still above that 200 SMA. If we are in a recession, my expectation is we're going to break right through it, and then, again, who will know where that bottom is? But if things aren't as bad as we expect them to be, I'm really looking at this $350 level on the SPY to really hold up. Again, it's been major support when things haven't been as bad as we expected. The COVID crash, again, things fell through the floor, but again, the Fed stepped up, and then it wasn't as bad as we expected because of all the money that flooded into the system. So the 350 area, which was key resistance back in 2020 as well is going to be a very key area when it comes to the large caps. Looking at the S&P 400 for mid caps, we're right on that level, and we already bounced off it just once for the past couple of weeks. So it's going to be another area that I'm going to be monitoring and seeing, are we able to hold up this 200 SMA, especially with earnings just around the corner, which are really going to tell us where we're going to be headed for the next couple of months perhaps. And lastly, the S&P 600 Small Cap ETF Spsm, again similar to the mid caps, right on that 200 simple moving day average on the weekly. Is it going to be able to hold up? We see that rollover ever since 2021. And again, aligning pretty nicely with the resistance that we had back in August of 2018 and right before the COVID crash in January of 2020. Even though it was a little bit below the 200 simple moving day average, it will be very interesting to see, will the 200 SMA hold up in the large caps, the mid caps, and the small caps? So this brings me to the question, what are earnings going to look like? We're going to get a bunch of major companies reporting in the upcoming weeks, from large caps, mid caps to small caps. We don't know, with the environment that we've been in, the high inflation, geopolitical risks, the consumer sentiment, people aren't spending money. There's been a lot of demand destruction because of interest rates rising. It's been very, very, very wonky. Again, since I've been in the market over the past few years, nothing has made sense. It's been one extreme where everything's going to the moon and the other extreme where everything is going to crash. Are we somewhere in the middle? What's the truth here? Again, no one will know until after it happens. Are Tesla and Microsoft, Apple, Google, Amazon going to come out with better numbers than expected? Are they as bad as we think? Or are they going to be even worse than we think? And then depending on what happens, is the stock market going to react positively to bad news or negatively to good news or somewhere in between? We're just going to have to see. So it's going to be super interesting. Let me know your comments below. As always, like the video, subscribe to the channel, and check out my description below for links to my Instagram, my TikTok, and my Twitter. I'll see you guys in the next video.